Well, I think there's a big debate going on. And if you look at the second, third, and fourth quarter of last year, you look at the mega caps and the rest of the stocks in the S&P 500, you'll see mega caps in the second and the fourth did very well. And the smaller cap stocks did very well, much better than the mega caps in the third quarter. I think there's a little bit of a tug of war evolving here. And if we're right, the most massive concentration in the market in history, worse than the Depression, is probably going to give way to a broader-based bull market. We're seeing that in our portfolios, and it really did start right around, actually, the day after the election. And I think one of the most important things is going to happen is regulations coming down. Even in AI, in the United States, their regulations started to intrude in a technology that is today where the internet was in the early 90s. We don't even know what we have yet. Yeah. We're as excited as back then, but now is not the time to regulate it heavily.
Well, I think you've got the president on your side when it comes to that in the States. I want to come back to kind of this idea of the hyperscalers here. You're famous for your beta strategy, especially when it comes to the tech space. I think it's fair to say that the highest beta right now is in some of these tech names, in Nvidia, in Microsoft, in Google. Just looking at some of the moves we've seen in the last 24 hours, not to mention the last 12 months or so. Why not increase your holdings for more exposure to the hyperscalers? Yeah,
we do think, we do own Meta and Amazon in our flagship, and we own more of them in our other more specialized portfolios. And in Europe here, we have an AI and robotics fund, and we hold probably most of them because they are going to benefit from the declining cost in AI. And even Meta, who was really the open source leader. DeepSeek is open source. I think Meta is saying, wait a minute, what's going on here? And they're going to use some of the techniques, the algorithms that DeepSeek has used to improve their own platform. So we're not negative on them. We think that the neglect of the rest of the market has been extreme, and that is going to change. That the strongest bull market out there is a broad-based one. A market favoring 6 or 7 stocks alone is not a strong bull market. And so if we're right, the bull market will strengthen out and gain momentum, rewarding smaller cap stocks than we have seen thus far.
Cathie Wood just dropped a bombshell of a revelation regarding the recent market behavior, and then she came back just to confirm it once again. What am I talking about? Well, how about the fact that she predicted a deflationary boom right after the current volatile market? Companies like Tesla, Amazon, and Nvidia have the spotlight on them since they lost more value than ever before. Can this truly be reversed? When will this prediction happen? Only one way to find out. Welcome back, everyone, to Investocracy.
Yes, if you look back at the Depression, I'm not going to get all of these numbers right. What you'll see is the massive concentration took place until 1932. Yeah. At which point the market started broadening out. And small or mid-cap stocks back then way outperformed large-cap stocks. And it makes sense. They had been absolutely destroyed during the Depression, which was binary. Is this company going to survive or not? With output down 30%, GDP down 30%. It is surprising to me that we got to an even greater point of concentration than the Great Depression. It tells you that in an underlying sense, there was a lot of fear in the market and that investors were piling into cash-rich companies that, oh, by the way, had, a leg up perhaps in this new thing called AI. Now I think it's just going to broaden out.
Cathie Wood's predictions are as electrifying as they are bewildering. She boldly suggests that the market, while undergoing a rolling recession, is unwittingly setting the stage for an economic renaissance akin to another boom in the market. So maybe all the dips and all the volatility is going to shoot all the stocks straight up sooner rather than later. But before going on with the video, are you into cryptocurrency? If so, check out our second channel, Investocracy Crypto. We bring you breaking news, expert analysis, and the latest trends in the fast-moving world of digital assets. Whether you're a seasoned crypto investor or just curious about the future of finance, we've got something for you. Click the link in the description to subscribe to Investocracy Crypto now. Don't miss out and stay ahead of the game. Now, let's get back to the video.
Productivity has been boosted to some extent, and you're right, it's very difficult to measure this. My background's economics, and in the 80s, productivity was a big question mark, and we saw how flawed the measurements are, and probably still are. So I can only tell you the rate of uptake is so much, is that enterprises are seeing a difference. Maybe if they're not laying people off, they're not hiring them. Mm-hmm. And we know that, and that's because these AI tools are making their own, especially engineers, so much more productive, right? So you just don't have to hire that next person. If you've seen the number of coding employees in the United States has dropped like a cliff. I mean, off a cliff. It hasn't dropped like a cliff, it's dropped off a cliff. And I don't know if you've seen that chart, so that very much has happened as engineers just become more and more productive. You know, one of the things that we're wondering is, okay, what part of the software stack will this, the traditional software stack, will this impact? And we think the AI revolution is what we see already losing share to some extent. It is still growing, but losing share is software as a service. And, you know, I think we're all paying very close attention to the revenue growth dynamics of these companies. A Salesforce.com, revenue growth isn't picking up. In fact, it continues to decelerate. I think it's next quarter will be, I think, 7% down from 9%. That's not what's supposed to happen here. And so I think that might be what you're referring to. Wait a minute, where are the top line dynamics? Where are they coming from? Well, I think we have a lot of entrepreneurs in a lot of garages or in R&D centers who are creating the next big thing. And, you know, we look at two profound ramifications of AI that we understand. We've been researching them for so long. The largest AI project on Earth is robotaxis, autonomous driving networks. We think that's going to drive $8 to $10 trillion in revenue globally in the next 5 to 10 years, up from zero now.
Optimists like Gene Munster from Deepwater Management are also cautiously revisiting the dot-com bubble's past, hinting at once-burned, twice-shy investment strategies. The prospect of a recession looms, acting as a potential brake on the AI trade momentum. It's a delicate dance of will they, won't they, when considering whether the markets will soar or slumber once more. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
We believe that real GDP growth globally is going to accelerate from 3%, where it has been for the past 125 years, to 7 to 8%, if not more, thanks to the convergence among these technologies: robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing. Now, why are we so confident about that? That sounds like an outrageous number. The consensus forecast is 3%. Well, the reason is, if you look back in history, you will see that about 125 years ago, 3 innovation platforms were evolving at the same time: telephone, electricity, and internal combustion engine. And what did that do to real GDP growth globally? It increased the rate of real GDP growth by 5-fold. We went from 0.6%, where the world had been over the 400 years, from 1500 to 1900. We went from 0.6% to 3%. That was a 5-fold increase. And now we're telling you, even though there are 5 innovation platforms evolving, with AI at the heart and soul of the acceleration in these technology platforms, that we're only going to see a 2 to 2.5-fold increase. We think that could be very conservative. And one of the reasons this is going to happen is because of productivity. Productivity is going to grow dramatically, and productivity is associated with low inflation growth as well. You can have higher wage growth if productivity is rising. So it's a win-win for everyone. And what a win-win means is wealth creation. And what does that mean for the stock market? Well, if we're right, then the value associated with truly disruptive innovation during the next 5 years in the equity markets, we believe, is going to rise from $12 trillion to $140 trillion, more than tenfold. Now, you might wonder what is going to happen to the Mag 6 during that period of time. Well, the Mag 6 will probably do fine altogether, although some will be disrupted by this new world order. That said, we expect the Mag 6 to go from 16 trillion today to 60 trillion. So that's about a 4-fold increase, maybe a little less than that.
So, where does this leave us as investors? With a deflationary boom sitting on the horizon, it might just be prime time to reconsider our portfolios. The breadth of Cathie Wood's vision suggests that those ready to weather the storm might indeed bask in the sunshine afterward. But what do you think? Share your thoughts. Finally, if you would like to know what companies like Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.